Hey everyone, my name is Alex Blackwood. I'm the CEO and co-founder of Mogul, and with me always is.
Joey Matautas, COO and co-founder of Mogul.
And for those of you who don't know us, obviously we're the fractional investing platform started by former Goldman Sachs alumni real estate investing. The one to my left, or actually to my right, who knows, is Joey, and he was the one that grew Goldman's single-family rental platform from 0 to 1 billion in under 12 months with 3 to 4 individuals. And so, a few years back, called him, asked him to meet me at a diner, and pitched him on the idea of what if we gave everyone access to quality of real estate that we were getting during our time at Goldman. And he didn't call me crazy because here we are. So we've been building this for about 2 to 3 years in the making. We've now crossed into the 14 or 15 asset mark. All of our assets have been performing quite well at around 18.8% average IRR. And today we're going to be going through a few different things on the property side, on the platform side, and everything alike. But Joe, did I miss anything, or did you want to provide any quick background on yourself too?
No, that's perfect. As we've always kind of run through, Alex and I were kind of moonlighting this project back where we were just lowly senior associates at Goldman Sachs, kind of making our way up the ranks and decided we wanted to, find a way to start democratizing the real estate process and providing access, direct returns with tax benefits to all. And so that's kind of how we got started on this. And now we're almost 3 years in the making and growing like crazy. So super excited.
Incredible, incredible. Well, I can go into a quick market update. And then for those of you who are just joining now, obviously feel free to drop any questions in the chat and we'll be more than happy to answer them throughout our time on the webinar. So, quick update from our end and things that we're seeing in the market. As you might have followed on our newsletter on the weekly basis that I send out on Sundays, we work through a lot of what we at Mogul are considering, especially as we invest in single family rental asset class. So I'll run through some of the high level items that we've seen over the past few weeks that have definitely impacted the way that we're viewing the economy on the go forward and the markets that we're looking to target. So number one, right off the bat, is obviously the Trump administration. It's at a completely high level glance. Obviously, everything seems to be in chaos or in flux, at least to a slight degree here or there. And so with that, we can break it down into a few of the different segments that people definitely should be considering as they look to invest in single family rentals. So number one are the tariffs. This is going to absolutely dramatically impact the construction industry, especially if supplies are flown in or brought in from other parts throughout the world. And so as people are familiar with, Trump is going to enact a potential tariff of 25% and in some cases an additional 10% on our neighbors to the north and south of us, as well as China and some other different countries there. And so if any steel or construction supplies are necessary to build some of these houses, you can imagine that shelter prices and home prices are going to go up. And so that will mean that supply on the onset will go down and home prices will continue to fly upward. And so that's on the tariff side. Now, outside of that is obviously the construction workforce that happens behind the scenes. And so the deportation efforts that are being led by the Trump initiatives now are definitely going to reduce the labor class that would be working on some of these homes. So again, you're going to see a reduction in the amount of supply, especially in the target markets that we're looking for. The next topic that we always like to bring up, I feel like a broken record, I tell this to Joey all the time, is inflation. It sucks to talk about, but it's always here and it's ever present. And this past month, actually, inflation jumped up from 2.9% to 3.0% year over year. Now, it's primarily driven by the fact that obviously shelter prices drove up by about 0.4%, which obviously helps when it comes to home prices increasing if you're invested in real estate already. But outside of that, I would caveat that obviously it's driven mainly by everything that's happening in the good space, whether it be eggs jumping up by 15% or the other different facets that make up that inflation. Now, why does it matter? It's because inflation and employment are going to be the two main things that drive the main economic lever that the Fed uses to stimulate the economy. And so the Fed has basically said that in two scenarios would they ever lower interest rates. Number one, inflation matches their long-term target of roughly 2%. Inflation in moderate doses at that 2% is relatively healthy. And then number two, unemployment, the job market begins to soften. Now, the job market has been ripping and inflation has been increasing. So we don't see that the interest rates will be going down. But however, I will caveat that with that doesn't necessarily make sense. That doesn't make it so that the interest rates on mortgages will go down, which Joey can talk to in a second, and what we're seeing here at Mogul. And so outside of that, obviously interest rates directly tie to the stimulus in the economy. Interest rates go down, economy starts to rip. Interest rates go up, economy starts to slow down. And the Fed, that's their primary measure to control the economy and have it grow in healthy doses rather than just everything everywhere all at once. Outside of that, obviously you've got Doge, which is front of mind for everyone, the Department of Government Efficiency. Now, I will say that a lot of what Elon Musk is employing is what he's done with his company so successfully in the private sector. Now, when it comes to the public sector, it's a lot more difficult to treat America like a startup, even though we are 250 years old. It's a lot harder to treat us like a startup. And so to make cuts like that in drastic measure, in some cases, well more than justified. I mean, we joke about it a ton, but pennies definitely should go away. It takes 2 cents to make 1 penny. And so that is something that they're looking to cut. But then things that are just cut all at once and then having to kind of Band-Aid over them is definitely something to consider, especially at the onset, because it is stressful here in DC. The tension's definitely there, but I will say in the single family rental market, the outlook could not be better. Outside of that, volatility of crypto coming out of the election, you had Trump coin, Melania coin, and now you had the Javier Milei sponsored Libra coin that obviously went from 0 to 4 billion and back down again. That just again strengthens the case for investing in inflation hedges that are stable even through market downturns or cycles, and so points directly to our real estate. And so with that, obviously if you're just joining now, feel free to drop any questions in the chat. But outside of that, Joey, is there anything that I failed to mention there?
No, I think just tying that all to kind of what that means for the real estate market now, thinking about, like you mentioned, segueing to kind of interest rates and what that means for mortgage rates specifically. There's a lot going on behind the scenes when it comes to pricing out your mortgage rates. U.S. Treasury yields on the 10-year is definitely something that's a major consideration. And so even though you're seeing interest rates either stay kind of where they are or fluctuate, a lot of the pricing that goes into mortgage pricing when it comes to their rates and especially the rate floors are, directly correlated to the U.S. 10-year Treasury yield and also factoring in what they think will happen over the next 30, 60, 90 days. So, we saw some fluctuations in the U.S. 10-year Treasury yield between now and November, upticks, downticks that have actually affected rates quite a bit. Right now, we are operating at the rate floor with all of our lending partners, which is tremendous, on a lot of the short-term rental DSCR loans that we're taking out that are interest only for 10 years. Mind you, are at the rate floor right now at 6.75%, which actually dropped from the 6.875%. And factoring that into kind of what pricing looks like in terms of a monthly payment, that's significant. Thinking about that on kind of the pad split side, that's now jumped down to even 6.5%, which is tremendous. On interest-only loans 2 months ago, you were seeing things in the high 8s, low 9s, right? Which means that the yields on your properties subsequently would need to either match or beat those APRs in order to be accretive kind of for the rest of your equity holders in the asset. So tremendous value, great that we're able to operate at the floor with our lending partners, and huge shout out to some of our major lending partners like Host Financial. And it's really exciting stuff. So pass it back to you, Alex.
Yeah. And I mean, one thing that we definitely want to highlight too, and of course, to sum up some of the stuff that Joey said is, just because the Fed isn't moving interest rates doesn't mean that the interest rate is not going down for the loans that we're taking out. Now, he did mention something that I will say is accretive versus dilutive leverage. Accretive leverage, again, accretive just means that your returns are higher if you were to take out leverage versus dilutive if you were to take out leverage and it dropped the return. And so there's things called unlevered versus levered return. Unlevered means not taking into account any sort of debt, so buying things all cash, not taking into account interest payments on cash flows. Then levered takes into account interest payments on cash flow. And not all debt is bad debt. There is accretive leverage out there, and that's what exactly we take out for each individual property. Now, again, if you do have any questions as we continue to go, definitely drop them in the chat or in the question section here. We'll answer them at the end in an entire Q&A session. And so with that, Joey, I mean, let's jump right into the meat of it. Let's jump into some of the assets. I think we have one special one. I'll let you do the honors on this and take it away.
Yeah, we're super excited to kind of do our first live drop of a property here on a webinar. So we're actually providing first right of refusal access to everyone here that's live and joining us. And Thomas will drop a direct link into the asset in the chat here that you'll see shortly, which will provide you direct access into the property link and directly into the property page that you can then check out as I walk you through it live. So let me go ahead and just share my screen here so I can walk you.
It was just dropped in the chat by Thomas, just in case you got a chance to see that. But
excellent. Let me know when you can all see this.
We can see it. Yeah.
Perfect.
Can you spread out the screen a little bit to make it? There we go.
That?
Yeah. There. Perfect.
Perfect. So just a very high level, this one is, it's called the Johnson. It's located here in the kind of Cesar Chavez submarket of Austin, Texas. You look down here at the map. Starting off with kind of the market, I think, which is really important. We've talked about kind of where the Austin market has fluctuated relative to other Texas markets, kind of, the secondary markets that we'd like to focus on, thinking the Houstons, the Austins of the world. Austin had its kind of top out in pricing right back in 2022, where it reached peak pricing. Since then, kind of going into the end of 2024, early 2025, we've seen about a 25% dip, and now prices are about to stabilize, which is tremendously valuable in terms of the value proposition that it creates for us as investors and for other investors looking to be exposed into the Austin market. Now, as I always caveat with, macro conversations and markets that we're looking at, there's always opportunity to create value in every market. You just have to look in the right pockets, right? Even when you're looking in some of your primary markets, as long as you're finding the right asset in the right micro location, there's always going to be opportunities to create value. So just want to highlight the micro location here. This one is, again, located kind of right in downtown Austin, actually in the Cesar Chavez neighborhood, which is slightly east of the 35. So this area is what I would kind of liken to some areas of kind of the Golden U of Dallas that are still very much up and coming, very high growth. There's a lot of entertainment, retail that's continuing to be developed throughout this neighborhood, whereas a lot of the growth that you saw previously, and I know Alex can attest to this just being there recently, was more so west of kind of the downtown area and north. So thinking through kind of the fundamentals here, the asset itself, it's an incredible asset. I mean, we can go through some of the photos. It's an operating Airbnb that has already achieved over 24 months of actuals. Now, over the past 12 months of actuals, there's actually been over $190,000 of post-fee bookings, which is tremendous given we are underwriting year one income at $210,000 pre-fees and about $165,000 post-fees. So we're underwriting rents in year one lower than where rents have been achieved kind of in the past 12 months, which is something that we always like to focus on. Not to mention, we secured this asset about 6% below listing price, which creates great value day one. Again, we're always striving to not be at the mercy of the market when it comes to market appreciation that we're baking into our business plans going forward. We like to be able to create that value via basis discounts and conveying of furnishings, conveying of major appliances, which I would like to point out that all of the furnishings here, from the previous operator are conveying. And it's about $100,000 of additional furnishings that would have otherwise been in a supplemental contract outside of the normal PSA, but we're actually including with the purchase, which is great. One additional highlight is that there is about $50,000 of bookings that came with the asset itself. So we transferred that over from the previous listing and actually are putting that into our listing with Surge. So huge shout out to Surge for making that happen, and our partner Umberto, the owner. But thinking through some of the kind of financials here, right now we originated a loan at 75% LTV, meaning 75% of that $1.5 million purchase price is going to be capitalized via that interest only 10-year DSCR loan that then converts after that 10 years to 30 years of amortizing, giving us the opportunity to stretch out the term, pay interest only in the first 10 years, and consider a refinance if we get to the end of that 10-year business plan. Again, we're secured here at the rate floor on the short-term rentals with our current partner at 6.75%. And we were able to get that with zero additional buy-down points, which is, again, tremendously valuable for the equity investors. Alex, maybe you want to kind of walk through some targeted questions that might be helpful to go through as we kind of walk through the asset itself.
Yeah, so we actually got one question from someone in the chat. Also, we got a question for, will the recording be available later? Of course, it will always be available later. We will send it around on the full recording. One of the questions was from Joe. The note on Mogul's page for the Johnson states that there are over a year of actuals over the 210K year one projection. However, the MLS listing says the 2024 gross revenue is only 190K, and AirDNA shows an even lower number. What am I missing? Just clarification on what it achieved versus what we're projecting out on that third bullet point.
Yep. So the key there is fees. The fees that one you're paying to Airbnb and to the current property manager in place. So as mentioned, typical property management fees will be around 25 to 35% of gross revenues when it comes to short-term rental managers. We've locked in 10 to 15% when it comes to negotiating our short-term rental manager fees. So when you're thinking about the nominal rents at the 210K versus what was actually achieved in payouts post fees to the previous owner at the 190K, that's where you're seeing that difference. And again, when you factor in even upwards of the top end of where our management fees are at the 15%, you're getting closer to that kind of 170K of post fee rents, which is well below that 190K.
Got it. So it's basically that property management fee being a lot lower with us is how you factor in the difference between the 190 and 210K.
Yeah, I'd also like to highlight, some of the comps here. I can pull them up also on AirDNA, but also just going through some of the rental comps here. I mean, there are two Airbnbs that are actually, one of them is on the same street here, the Airbnb 4514, and we're happy to send out these actual listings in addition to the recap after this webinar. But these are actually achieving rents. And if you look on that same AirDNA post that was just commented on in the chat, 243,000 of annualized rents, and that one was operating at, I believe, a little bit above 60% occupancy, which is just absolutely mind-blowing. Again, same product, same square footage, same beds, same baths, and I would argue that our finishings and amenities are better. Similarly, there's a Verbo a little bit west of the 35 that's actually achieving $330,000 of annual rents, and that's on actuals. It's about a third of the square footage, same bed, same baths. But again, just great signaling to some of the efficiency that we create both by increasing gross rents, but also decreasing OPEX here. Again, all that matters at the end of the day is NOI, right? So if you have higher gross rents, but a lower NOI, that's a lot less valuable than having lower gross rents and a much higher NOI. So again, huge shout out to our operators in Texas and again, with Surge, who has been tremendous at, generating those 1% plus yields to date on a lot of the Texas assets that we've been paying out. But definitely want to highlight these comps. I mean, this is just tremendous value on what we're already achieving as kind of a conservative $210,000 going forward.
And then I guess you did talk about obviously the sub micro location within Austin, and there's definitely been some concern around the supply. And I know that you walk through in great lengths, but a lot of times that you define, especially within the Dallas markets and some of the other markets, is this path of growth. Can you define like what path of growth means to you in this Austin market? And basically how were you thinking about the path of growth, especially from the economic factor that drove to this asset being attractive in the micro location within Austin? I know you obviously highlighted that growth topped out in the West End, and then obviously in the East is where we're seeing a little bit more growth, but would love to get a sense for how you're thinking about the path of growth.
Yeah, so what that really means is, again, following the demographic shifts of, again, where kind of retail entertainment is being developed, right? So, a lot of the supply kind of east of the 35 is it very much older supply. That's not, there's not a lot of currently new builds that exist. A lot of the neighborhoods have kind of been around since Austin started to flourish. And so when you look at a lot of the development that's happened kind of west and north of the city, there's a lot more saturation when it comes to rents, right? In terms of rents topping out, which is a big indicator of growth, especially the path of growth that we like to identify in our MSAs. When you see rents topped out, which is typically highly correlated with the development of retail and entertainment kind of centers, you're going to be able to see the path of growth again as it spreads more east. So anyone that's been to Austin can attest to a lot of the kind of area that's already more core, right? When it comes to downtown, again, more west and north and kind of directly downtown, directly west of 35. And then you'll start to notice that as you go further east, you're seeing a lot more development that's currently happening and is planned to be happening in the future, right? So when that comes to housing deliveries, when that comes to rent and rent increases in the past 5 years, you're actually seeing a much higher trend kind of towards that eastern region. So that's what we're focusing on when we talk about the path of growth.
Got it. And then for the operational bookings on the go forward, one of the questions that we received is, will we be able to take over the Airbnb reviews? And if that obviously is what we're going to target with this one, or if it's going to be starting fresh, but keeping the bookings in place. Because obviously I know our property management team definitely prides itself on the highest reviews possible, and just want to see what your thoughts are on how we transition over.
Yeah, it's a great question, actually, and we've definitely looked into it. So you're technically not allowed to actually keep a previous listing in place. I know it happens all the time, but we like to do things by the book. So we're actually keeping the bookings that exist and transferring them over to our Surge account, who actually handles all of our properties in Texas. So we will lose, the current reviews in place, but we'll have the opportunity to perfect those, at the 5 stars that we were trying to achieve on these existing bookings going forward.
And then how do you think about property taxes within Texas? We had discussed a little bit on the transparency laws that you had mentioned. And so I'd love to get a sense for how you're thinking about it, especially in underwriting for all assets in Texas going forward.
Yeah, as we always talk about, we like to be as conservative as possible when we're thinking about our underwritings, and especially when it comes to our cash flow analyses. So when you're thinking about some of the operating expenses, taxes is a huge piece of it, right? Taxes, insurance, principal, interest, maintenance. So right now, there's effectively a movement towards being more of a transparency state, right? Like, for example, when you transact a property in California, your assessment switches like that when it comes to your new taxes, right? And there's no assessment ratio and millage. 2 things are applied to the value of your property to arrive at your taxes. One of them is a millage rate, and the other is an assessment ratio. The assessment ratio varies, especially in your secondary markets, where it's actually most of the time below 100%. California, transparency state, is 100%. Texas is trending a lot more towards that 100%. So conservatively, we need to be able to underwrite our taxes going forward as if the property is going to be assessed at full value. It's safe to do. Again, there's a chance that it takes time. For whatever reason, the appraisal comes in lower than where the mortgage appraisal comes in. It happens all the time, but we need to make sure that we're underwriting the worst case scenario, even in our base case, because we don't know what exactly those taxes can be. So that's how we're going to be looking at every asset in Texas going forward, right? Is with those full tax burdens integrated into our year 1 underwritings and growing with those OPEX growth rates.
God damn. I mean, that's I'll caveat with to the audience that none of this questioning was prepared beforehand. I'm trying to stump him as hard as I can. So this is good work on that. I mean, literally, we just have ask leading questions in this section. If you do have any questions, definitely feel free to add those in the chat. So I guess one of the things too that we didn't highlight as much, but definitely a factor here, is the purchase price discount that we negotiated in there. Can you talk a little bit more about how you're thinking about the value? And especially, I know that this is one of the larger assets that we've offered out. So how did you get comfort around that $1.5 million purchase price?
Yeah, absolutely. So that's actually a great question. And I want to segment that kind of into 2 pieces of it. One, obviously, when you're looking at single family rentals, the opinion of value, the formal opinion of value that you get in your appraisal is going to be off a sales comp approach. Now, for everyone that's done real estate valuations, there are 3 approaches to value, right, in any real estate asset. The sales comp approach, the replacement cost approach, which is the replacement cost to actually build the asset on the land, the improvements upon the land that they're built, and then the income approach, right? So with assets like this, we're actually seeing a massive opportunity to start integrating the income approach into the valuations of this. Now, when you look at the sales comps here, there's plenty of sales comps to justify, especially within the past 3 months, sales in this range for this exact product in a similar submarket, and if not similar micro location, at much higher prices nominally, and then similar prices per square foot. But thinking about kind of where the income approach comes into play, you're operating this as an Airbnb, right? It's no secret. A lot of the other assets that are in this price range with this buy box are operating as Airbnbs. So although the appraisal market as a whole won't necessarily fully factor in those 1007 short-term rents into their opinions of value, it very much matters, because when you're looking at liquidity on the back end for selling an asset like this in the open market, 8 times out of 10, you're going to be selling it to another investor who's looking to operate it as a short-term rental or through their own business plan. And so when you're thinking about the income approach, being able to optimize the income and, again, increasing that income right from that 210,000 starting, even if you bump that up to 250,000, that's $40,000 of income that you're actually capitalizing on a cap rate of, say, conservatively even 10%. That's $400,000 of property value that you're creating through that income approach, right? So that's how we like to think about our valuations. That's how we like to think about how the income approach comes into play when you're thinking about generating value for this property, and why we're able to back into this $1.5 million price, even lower than where the $1.6 million listing price was, because the income justifies the price on a very, very high NOI cap rate, which is synonymous with that yield that we always talk about, right? And then you take out your debt service, through those DSCR loans with an APR much lower than that yield, and there's your cash on cash yield that we're projecting going forward.
So a few different things there too I want to highlight for the audience. You mentioned DSCR, so that's debt service coverage ratio. That means just rent divided by the actual payment that you make to meet debt service, so your interest expense, your principal, and all that. So that's what you think about, especially getting a DSCR above 1 means that you can meet your debt service with the operating or the revenue from the rental property. DSCR below 1, obviously, I mean, I don't know if we would even take out leverage at that point. But outside of that, so that's that one. The cap rate you'd mentioned, so that's, again, net operating income, so your rental income minus your operating expenses, not taking into account any interest expense, so not taking into account your capital structure, because that's what an investor can decide when they look to invest in a property. They can play around with the returns to basically maximize yield, maximize appreciation, and minimize yield. So there are different things to do there. So the main metric to consider is cap rate. And a lot of times, obviously, single family rentals are a little bit different, given you do have emotional sellers and emotional buyers. So cap rate doesn't fully take into account. But cap rate is that NOI divided by the purchase price. And then a lot of people use the inverse to basically come up with the valuation. So your NOI in year 1 divided by your cap rate gives you your purchase price. And so that's kind of high level there. APR you'd mentioned, which is what it's annual percentage rate. Is that, or roughly around that? But basically your effective rate of payment on your loan. A lot of times APR is used not with interest only loans, but when you do have to pay down principal and interest, it's used as a rate to calculate that annual payment that you're going to have to make over time. And so those were 3 different quick definitions that you threw in there, but Joey did a phenomenal job walking through that. I mean, if you don't want to invest in real estate anymore, you should write a textbook on this, because you have a clinic there. And so outside of that, if you do have questions, definitely throw them in the chat. I will say that is our main focus on the Johnson right now. It's going to be available fully tomorrow. We're going to unhide it for the masses. So if you do want to get in, obviously our assets have been selling quite quickly in the last little bit, having sold out, was it 3 assets in 3 weeks, and then 3 assets in January alone. So things are definitely starting to move over here at Mogul, and this is our 3rd asset we're listing in the 3rd week. So if you do want to invest in the Johnson, it's available in the chat, that link right there. You can invest well ahead of everyone else to reserve your spot. And so outside of that too, I mean, Joey, is there anything else that you want to add on the Johnson here? If not, and if anyone has any questions, if not, I think it might be a good time to go through pad splits and more specifically the MAFI, because obviously there's a little bit of allocation remaining, about 30% left there. And so I can let you take it away and go from there.
100%. And I'll share my screen so everyone that's more of a visual learner can also follow through. If they choose on the asset itself, let me know when you can see that.
Damn, 6K more since 5 p.m. That's good.
There we go. Awesome. So I can just give a super quick overview of kind of what we're looking for in terms of value on the pad split side of things, and kind of how we decided on starting that vertical, where we're looking to take it. I think one of the biggest answers to multifamily saturation is kind of workforce housing, right? That midterm housing, that sweet spot between short-term rentals and long-term rentals, where you're looking to achieve NOI yields that are just as strong as short-term rentals, but actually doing it through a much safer business plan by guaranteeing monthly leases instead of more daily leases, right? So insert pad split. Effectively the headline is they are a rent by room midterm leasing service. They rent by rooms for 31 day plus and actually are completely compliant with all cities that are looking to introduce or have introduced ordinances that limit short-term rentals in any way. The legal definition is usually those 31 days, that 30 to 31 days. So being above that as a midterm rental actually circumvents, all those ordinances. And then when you're renting on a rent by room kind of lease, you're actually creating a premium to the overall nominal rents that you can achieve in a home. One, because in the pad split model, you're actually creating more more rooms to rent. And then two, because when you cut up the rooms like you would in a multifamily or in a hotel, you're making a lot more per room and nominally per the whole property than you would be if you were just renting out the property as one single unit. So here we can segue kind of into the fee, what that means, kind of what we're looking at this asset itself. So the fee, this one is a pad split that's been operating as a pad split for over a year in Decatur, Georgia, and it's a 7-bedroom, 2-bath, 2,200 square foot property that's out there. And so you might be thinking 7 bedrooms, that can't be. They've actually converted the property from a 4-bed, 2-bath to a 7-bed, 2-bath. Again, individually leasing out the rooms without changing the foundational structure of the property for a premium, kind of in comparison to what you'd be able to achieve if you rented this home out as an Airbnb when it was a 4-bedroom home, and then also much, much higher than you'd be able to achieve if it were a long-term triple net lease on a 4-bedroom, 2-bath home in Georgia. So that's the idea. That's the thesis. That's where pad split was born. Now, how we like to analyze our pad splits, right? We like to capitalize these just like we would any short-term rental. Number one piece of the pie here, and one of our biggest differentiators, is the fact that we can take out, again, that accretive leverage. And as Alex explained, that just means that the leverage makes our equity investment as equity investors and as the owners of the home much, much more valuable than they would be otherwise if we own the home outright, right? So I always like to give a super quick, easy example. $120 home, if you're taking out $100 of mortgage on it, you have $20 of equity that you've invested into the home. Let's say the home is generating $12 of rent per year, right? 10% after expenses, so like 10% NOI. You're splitting that NOI between the equity holder of this $20, which is due that $20 divided by 120 percentage of that NOI, and then the rest would be going to the other $100, which is owned by the lender. But because you've pre-negotiated an APR there, which in this case is actually 6.75%, even though you're generating 10% for the entire property, you're only due that 6.75% to the lender. So that rest of that 3.25% is actually due to you as the equity holder. And even though you only own 20%, you're making that extra 3.25% of the 80% of the cap stack to yourself. So I think I made that a little more complicated than it usually is, but we got there.
You can definitely tell which of us are early risers versus who comes alive in the night, so to speak. You threw around some numbers there, but one of the questions, I definitely want to let you run through more of it, but we do have some questions too, and feel free to leave more in the chat. So happy to either take it with the questions or if you have some stuff that you wanted to run through on the property.
No, yeah, I would just say, again, we really like to drive off the thesis of it's an existing pad split. We're underwriting year-on rents just as we would on a short-term rental under where the past 12 have been. We've fully diligenced the OPEX through the owner statements and the payouts that have come from pad split. And again, this one has 7 different leases with tenancies over 12 months, actually, which is tremendous given the pad split average is usually sub 3 months. And the Georgia average is slightly higher. So thinking about, just again, where the business plan lies and how we're thinking about generating on the pad split model, very, very similar thesis to what we're looking at on short-term rentals, but much more of a stable business plan because of the operations on that higher tenancy of those, average 12 months. And because they're on 31-day plus leases with more stable tenants. So I'll just caveat that.
Incredible overview and great Great overview of the pad split model. Definitely is one that we're going to continue going forward with. And I will say, so we did have another question. Joe, thank you for adding in the question. I will say I definitely appreciate the harder questions, and this is definitely one of the harder questions. When we have a property with quite a bit of deferred maintenance like the Mafee has, of course, yep, definitely not the most attractive looking of our assets for sure. We've definitely heard back on that. But have you considered providing additional insight regarding which inspection items are included in the initial budget? I'm assuming many of the items will be taken care of, but it would be great to know which will be addressed immediately and which one we just plan to live with for the time being. And obviously, definitely, that's the question, Joey. So you'll have a second to walk through that. But Joe, you definitely highlighted it in a very thoughtful way at the end by saying which ones we're just planning to live with for the time being. Obviously, the job of the inspection report is similar to a doctor, point out every little thing that is wrong with you. And there are some things that take care of themselves, or some things that aren't necessarily as, I guess, necessary to fix right away. And there are some things that are fixable in 5 to 7 years. And obviously, that's exactly what you mentioned with the deferred maintenance with Joey. Would love to hear your thoughts on that question.
Yeah, absolutely. And it's a great question. I'm actually happy to talk about it. It's very, very granular. So the idea is we get back an inspection report, which we order right after we go under contract, right? That's the first step. Effectively, when we get that inspection report back, it's our job, along with any broker that we're working with, to review each and every single item that's actually pointed out in that inspection report. And I can safely say any item that is ever labeled as an address now, safety concern, any sort of in the red versus the yellow versus the blue or green, often it's colored, in terms of must be addressed and when. Anything that's in the red will always be addressed prior to closing, either by the seller from a direct request that's then verified by, one, a licensed contractor, and two, receipts from that contractor directly sent to us prior to closing. So that way you, as the equity holder, post-closing, obviously don't have to deal with that. The second piece of it is we also frequently negotiate seller credits, right? So there's actually already a $5,000 seller credit that you can see in the PSA baked into this property. But there's an amendment that was filed to address all of the items that were pointed out as address now items in the red. And then actually we split the difference on some of the more truly deferrable maintenance that does not at all need to be addressed, as Alex said, but should be down the line and could be. And so we actually usually split that difference, ask for additional seller credit. We receive that seller credit that goes directly into the property basis discount, right, that you're getting in terms of how much equity you're providing to close on that $300K plus your capitalized cost minus your debt that you're taking out as a mortgage. So every dollar that you can get from that process goes directly back to you as the equity holders. And it's a process that we have to go through with every single property. I'm actually really glad that someone's bringing light to it, because it's one of the most important pieces of the due diligence. It would definitely bore everyone to death if we had a dashboard showing what exactly items, are being addressed, simply because there's just way too many things to go through across, tens and what will be hundreds of properties. However, I love the idea of giving an update, and especially if the questions are asked, we're more than happy to provide the diligence always. You'll see the inspection reports fully transparent, included with every listing, in addition to the purchase and sale agreements outlined with all of the credits that we've negotiated, and any items that are going to be addressed with the seller prior to closing. So it's a great question. Love it. And happy to go through it.
Yeah, we've always discussed live streaming some of the more boring things done during real estate investing. So that click that you do, which is 30 seconds or less, obviously, to invest in a property, definitely a lot of headache went into that one click. And there's a lot of things that went on behind the scenes, especially as it relates to the inspection report. So maybe we'll take a note and send it to Thomas as the next live stream will be reviewing an inspection report or closing on a property. But that being said, any other questions, definitely put them in the chat there. I guess, Joey, obviously curb appeal was not the factor going into this property. How do you get past that as an investor? How do you think about this asset? Because this is definitely one of the things that's been brought to light the most with us is this asset absolutely yields a tremendous amount. I think it's 10% cash on cash yield year one, with appreciation obviously in that sublocation, boosting it to a very significant double-digit IRR return. So I guess, how do you get past, as an investor, really digging into it and getting past the curb appeal of the asset? Because obviously, definitely not the best looking of all of our assets.
Yeah, absolutely. And one, I would say that we've had some tremendous looking assets, so it's definitely hard to keep up with some of the better looking ones sometimes. But my answer to that is, it really comes down to the tenancy profile, the demographic, the business plan. The idea being that, again, with a short-term rental, you're effectively buying an operating hotel, right? It's all curb appeal, it's all flash, it's all what's going to attract someone that's staying there to rent it on a daily basis for a relatively very high premium that will translate into, a higher, again, gross rent to us as the investor post vacancy that's associated with operating a hotel like property each month. And so the idea being that, you want full amenities, right? You want full, the best furnishings, the best finishings, the best furniture. And the idea is that it's going to look incredible, and the pictures aren't going to lie, and the Airbnbs are all just going to look really, really good. When you're thinking about your longer term rentals and your midterm rentals, you're renting to a tenant profile that's looking to actually call this a primary residence, right? So they're bringing a lot of their own character to it. They're bringing a lot of their own furnishings to it. The idea is that you're creating more of a home and less of the glam that comes with operating, again, that Airbnb kind of short-term rental hotel-like product. And you're operating it with the idea that a lot of the tenancy in terms of the use of the home, what's being brought into the home, how often the home is being used, is dependent upon, again, that tenant profile that you're going for. So when you're thinking about a 31-day plus rent by room lease with 6, 12, 3-month tenancy profiles, you're not necessarily going to be thinking about the person that's looking for a hotel to stay at for one night with their friends. You're looking for someone that's could be a travel nurse that's in town for 3, 4, 5 months at a time. You're looking for someone that's working kind of along more of your industrial corridors, right, that are sprouting up along kind of Georgia and Texas and a lot of the markets that we're looking at in terms of the pad split product, including Arizona as well, right? So you're thinking about people that are on the road a lot for work, that don't necessarily need to be buying a primary home, don't want to rent a multifamily apartment with a 6 or 12-month lease that you're locked into, but are looking for a pad to effectively split and sleep at. Obviously, funny pun intended, but it's true.
You didn't have to do it, Joe.
I felt I had to do it, but
you had to do it, Joe. No, I love that. I love the analysis that you put together, obviously, because if you think about the hotels, I mean, having worked in hospitality investing, the limited service, select service, full service, the entire suite, it's exactly what you said. It's there is a tenant for different types of asset classes, different types of operating models. So I completely agree with that. That's a phenomenal allegory there. And so I guess some of the questions, and keep in mind, we'll open up the questions too. So feel free to drop any and all questions. We can use this next 15 minutes. I know we've been doing a lot of talking. So if people have any questions, feel free to drop them in the chat. It doesn't necessarily have to be specific to the property at all. It can be about what we are looking to do on the go for, what the platform is looking to do. Is there anything that you think we could be doing better? What did Joey have for lunch today? Pretty much anything you can feel free to ask, and we will answer it. We're as transparent as they come when it comes to investing. Outside that, I will say we do have some pointed questions that were sent to us even by some people that couldn't make the webinar. So I'm happy to pepper in some of those as well. So I guess right off the bat, what on the go for it, Joey, when you're focusing on the split between short-term rentals or the steady influx of pad split, how are you thinking about the portfolio as a whole on the Mogul platform?
Yeah, great question. Our buy box changes every single month. We're not someone that likes to set it and forget it for the year and just kind of operate off that. We're constantly tracking where those mortgage quotes are coming in, where our purchase price needs are at in terms of the demand that we're achieving on the platform, the yields that we're looking to give out to you guys in terms of what you're prioritizing in terms of, is it more yield driven? Is it more appreciation driven? there's always going to be the appreciation story baked in every asset. We're always looking for, again, those micro locations where you're not topped out in growth, where you can achieve basis discounts, where you can convey furnishings worth $100,000. We're always going to be trying to achieve that. We're always going to be trying to get the top end of those seller credits, right? That will cover that deferred maintenance. We always want to make sure we're benefiting the buyer and creating that value. But when it comes to thinking about the needs of the customer and kind of where everyone wants to achieve also that kind of yield product, right, on those 8 to 10% cash on cash yields each year and growing from there, right? Mind you, these are only the starting rents that you're seeing for the first year. We're very much focused on creating that yield and that value. So where do I see the split? I would say right now we're definitely focused on the short and midterm rental models, being that the yield premiums are there to meet that debt service, at that 6.75, 6.5%. When those rates come down and they're closer to that 4-5%, we will very much start looking towards the long-term, triple net lease models again. And believe me, it'll make our lives a lot easier. The management on it, the asset management on it, the low touch, it's much easier to manage those longer term rentals. However, in order to achieve the premiums needed to beat the market right now, right, we're going to have to focus on these higher yielding business models.
Great answer, and great answer on the go forward. Definitely something we're considering, especially on the go forward. But I guess next question. Thank you, Joe, for answering that. Next question in the chat is, what's the timeline to create a marketplace to provide liquidity on the investments? I can take that, unless, Joe, you wanted to take it, but I'm happy to.
No, you're the expert. You are the residential expert.
Perfect. So I had a chance to work with market infrastructure players during my time at Goldman Sachs in their investment banking division, had a chance to see firsthand how they're going to do it. Now, timeline answer, we're targeting by Q2 of next year is the goal to unlock that liquidity for shares of ownership in the properties. However, the target is to create a fully liquid secondary. It's not to create some peer-to-peer marketplace. Now, a lot of the problems that happens in a peer-to-peer marketplace is what's called a speculative bid-ask spread, meaning when you go to sell it, there might not be someone on the other end of the transaction to take up that what's called liquidity, or soak up the liquidity, so buy it from you. And so if you go to the New York Stock Exchange today or the NASDAQ or any other major exchange, there's someone that's traditionally buying from you that isn't necessarily another retail or individual investor. Traditionally, it's a market maker. And so a market maker like the Citadels, the Virtues of the world, basically pay a ticket or a fee to be what's called a supplemental liquidity provider on the New York Stock Exchange or the NASDAQ. And the idea being that they come in with the right to purchase and sell the assets at the true asset value and make the market, so to speak, and so provide that instant liquidity. Now, the real estate that we're looking to transact on, the real estate that we're actually offering out, each individual property is what we would deem as an IPO worthy property. And so initial public offering, so that first time offering it into a public market. And so there obviously are some bad stocks out there, as witnessed via the SPAC collapse that happened with a number of different stocks. However, for a company to be IPO worthy or IPO quality, they do have to have a lot of the fundamentals in place to even go public. And so there's not going to be a market maker that comes in and makes a market for an absolutely horrible asset. And so that's what we're looking to do here, is focus entirely on the quality now. Now, coming in with a line of credit to provide instant liquidity and be the actual market maker, providing you liquidity at the true asset value, is how we're going to eliminate that speculative bid-ask spread and give you that instant liquidity at true asset value. So we could technically turn on this peer-to-peer marketplace tomorrow, except it would create a whole lot of chaos and wouldn't get you the best price. There has to be some sort of market infrastructure in place. And so that's what we're working on this year into the beginning part of next year, is providing that true instant liquidity and a way to liquidate out, and so that the asset doesn't necessarily need to sell in 5 to 7 years. That being said, obviously, definitely look at real estate as a long-term investment horizon. And so 5 to 7 years, that's typically the asset lifespan. However, we are obviously trying to do a first of its kind, truly liquid marketplace for secondaries. And so thank you so much, Lou, for calling that out. That's something we put a tremendous amount of thought behind and are in the process of crafting out now. If there are any other questions, obviously feel free to lob them into the chat. But one of the other ones that was probed are, oh wait, actually, we just got another question. Is the tax form a K1 or a 1099? It is a K1. We're in the process of working through that right now. We will have an updated timeline over the next little bit. We're actually getting on with our CPAs and accounting team tomorrow morning to walk through everything. We've been working on them since, I kid you not, October of this year. So it's definitely been front of mind on the tax documents to make sure they come in a timely manner. So if there are any other questions, feel free to lob them in the chat. But one of the other questions that we got sent to us prior to this, are there any new markets you guys are looking to at over the next few property launches? I mean, Joey, resident expert, what are we thinking?
Yeah, definitely. We want to do more product kind of in and around, the Denver and Boulder areas in Colorado. We want to focus on Nashville, which has been a really interesting market. We just haven't found the right opportunity yet. So definitely looking to introduce more markets in the near term. And we have our eyes peeled, across the Carolinas, right around kind of the Charlotte areas, and South Carolina as well, actually, where Alex has a lot of good personal exposure. So right now, I think, you're going to see a lot more product being rolled out in the markets that we know how to operate in, and you'll see new product listed, in the new markets in the coming weeks.
Definitely. And so will another question that was asked, will each separate property get an individual K1? That is the target, is to provide an individual K1. Now, they should be able to stack up and put on the end of your tax returns working with an accountant. However, hopefully they should be all passive losses for income reporting purposes, which, to be honest with you, if you take the standard deduction, it only means that you wouldn't pay income on the taxes from the rental income that you're paid out. It wouldn't necessarily impact a passive loss against other passive income that you have. However, if you do line item by line item accounting for the individual losses, that's when it would take into full effect the passive loss against other passive investments. And so that's the answer to that question. If anyone has any other questions, definitely feel free to send them in. There are, outside of that, I'm getting some other ones that we had. I was reading on your website how you use blockchain for a more efficient back office. Can you go into more detail as to how you use blockchain at Mogul and how it affects investors? To be honest with you, it's and Joey, I don't know if you want to take that or I can take that.
You're by far the expert, so go for it.
Yeah, so I got a chance to work also with blockchain-focused financial institutions. Actually, RIP. It's too heavy. There's a deal on my desk that's silver. It's a Bitcoin. It's a Bitcoin deal. So during my time with Goldman, with blockchain-focused financial institutions, it's too heavy and the globe keeps falling off. So, but it's a Bitcoin in the base. Anyway. Blockchain is more efficient back office. Again, real estate and blockchain were made for each other. Title, all it is a chain of title. And what is blockchain but a chain of blocks of immutable transactions, one after another. Now, you as an investor, if you don't care about blockchain and you don't really want to know about blockchain, again, it's very different than crypto. You don't have to know about it to use our platform. You can invest directly using any sort of USD or your bank account, all the traditional payment methods. Now, for us as a more efficient back office, you have to think about the way that you would do it in a traditional sense. If Joey and I were to invest in a property together on an investment LLC, and then we were to have a third person buy in, there's a tremendous amount of paperwork that would go in to amend all of the different operating agreements. However, with blockchain, it is such that you can buy in on a moment's notice and it's already updated the ownership percentages in real time. And so the idea being that it allows us to provide the lowest minimums that we can at the $250. It allows us to charge a much lower fee than our competitors because of the fact that we don't necessarily need to have some in-house attorney that every time anyone buys in with a $250 thing is send out a DocuSign. So this is a smart contract, and it just recognizes when funds have hit and when you'll receive ownership in the property and records that ownership in real time. So we can use that too when we send out dividends. We calculate it on a daily basis. So even if you invest midway through a month, you will receive half of that month's dividends on the next Tuesday of the next month. And that's the benefit of blockchain in a nutshell. There will be more benefits in the liquidity secondary market, but that's going to be a conversation for another time. If there are any more questions, definitely feel free to lob them into the chat. We're more than happy to answer anything at all. And then I noticed recent property launches mention MOIC, multiple of invested capital, quite a bit. Can you explain what that means, Joey?
Yeah, absolutely. So the multiple on your invested capital, again, is going to be focused on what that, well, you can look at it from an unlevered basis, which means without debt, right? And so that'll be if you just look at it surely as a return on your equity, if you bought the property all cash. And then you look at it from a levered perspective, and that's the MOIC, the multiple on invested capital that we highlight in our emails and launches. And that's actually going to be the multiple that you're receiving through an underwritten time frame on your equity as the equity holder. And so you'll notice that the MOIC is actually higher if you go on the calculator pages for any of the properties or the analysis tool. The MOIC for levered property on the levered side is actually higher than the unlevered, even though on the levered side you're making a lower profit. You're actually making a lower levered profit and a higher profit on the unlevered side. The idea being that it's because you're making it on a smaller amount of equity, right? So if you're, again, it goes back to the example of that accretive leverage and making a higher return on the smaller amount invested. You can buy that $100 property with $100 in cash, make 10% in rent on it a year post expenses, and then 3% appreciation, which is $3 on that $100. $3 on your $100 of equity is only 3%. But in that scenario where you have that 20%, right? So you have $20 of that $100. You're making that $3 on your $20, right, per year in appreciation. That's compounding. So that $3 on your $20 is a much, much higher return marginally than the $3 on what would be that $100. Translates the same way into your MOIC. That MOIC takes into account all of the investment activity from your yields and your appreciation through a hold, what that return looks like on your invested capital. And that also takes into account any additional invested capital through the hold. And then that's what returns your multiple on investing capital from that levered profit that you're looking at.
Yeah. So the idea of 1.3 means it increased by 30% too, your dollar amount.
Yeah.
Right?
Yeah.
So one of the last questions that we have, and feel free to lob in any other questions that you might have. How does Mogul differ from other companies in the space, such as Fundrise, Arrived, et cetera? And so I guess there are two things that we can factor into it. Number one being commercial real estate versus single family rental investing. And number two being the platform itself and the efficiencies that we create. So number one being on the commercial real estate investing, I believe it's Fundrise that goes after primarily commercial real estate. They ventured into venture equity, or venture capital, which don't really understand why. It's a real estate related platform. Anywho, the idea being that if you're competing in the commercial real estate space, think about the other players that you're going to be competing against on the low end. In the $5 to $10 million range for a multifamily or small little office, you're going to be competing against a lot of other very savvy financial investors that are coming at it with all different sort of efficiencies that they can unlock. And so then you swim upstream a little bit, right, in that $10 to $50 million range. Now you're starting to get in the deep end, so to speak. You're starting to tread with the big boys, so to speak. And so with that, you're going up against people that can outgun and outplay you or outfinance you in any sort of capacity. And then even further than that, 50 million and beyond, and you're going up against some of the mega funds. Now, again, you're not going to win against Blackstone or Goldman or Carlyle or any of these other major funds out there, especially if you're coming in to a bidding process with the crowdfunding component to it. I mean, Joey can attest, sellers literally ask for buyer interviews where they interview the buyer, they ask for proof of funds, all these different things. And if so funds are coming in at the time of closing, a lot of times the seller will most likely go towards a different buyer. And so they're left with the scraps or different assets that aren't necessarily the best. Now, in terms of the second component, which is just us versus other single family rental investment platforms, the truth is we typically target a higher return profile than our competitors. Our IRR is on average 18.8% versus the next best one is, I believe, on average about 6% at this point due to our current underwritings. And so really comes down to the people at the helm of the supply. And so, Joey, I mean, I grilled you on a lot tonight, and you were coming out with millage rates, which obviously that's a very in-depth, deep think term, so to speak. And so definitely it comes down to the fact that we're the ones that did it before, or Joey at least definitively did it before at Goldman. And so we're bringing that to the masses, that higher return profile and the quality of real estate. And so with that, I mean, that's our time. If anyone has any last questions, definitely feel free to lob them in. But really appreciate everyone joining today. Again, we've been ramping up our properties. We've launched a property a week for the past 3 weeks. We've sold out a property a week for the past 3 weeks as well. And so demand is starting to hit, supply is starting to hit. the quality of asset is continuing to even increase because we've seen just the efficiencies we can unlock as a platform, especially at scale. And so when we scale up, the property and quality assets will only continue to go up, which is absolutely tremendous. So thank you again, everyone, for joining. I don't know, Joe, if you have anything else. Oh, this will be recorded and sent around later. If you want to access that property ahead of its launch tomorrow in Austin, Thomas just dropped it. Again, that's another plug. You can invest tonight before the masses get access to it. But Joey, I don't know if you had anything else.
No, couldn't have said it better myself. Yeah, I really appreciate everyone. Really appreciate you, Alex. And thanks everyone for the time.
Thank you. Appreciate it. Have a good one.
Awesome.